ko. Okay, good evening. I'm going to begin with 10-11 because we have already finished 10-10. Okay, so in 10-11, we are asked to determine the amount that should be reported as total expenses in the first quarter ended March 31, 2020. The company is preparing the interim financial statements for the first quarter ended March 31, 2020. Expenses in the first quarter totaled 4 million, of which 25% was variable. The fixed expenses included television advertising expense 1.5 million, representing airtime to be incurred evenly during 2020, and depreciation expense of 600,000 for 2020 for an equipment that was available for use on March 1, 2020. So for first, since we are asked to determine the total expenses, first we have to include variable expenses. Its total of the expenses is 4 million. That's for the first quarter. And by the way, we are asked to determine the total expenses that should be reported for the first quarter. So if the total expenses in the first quarter is 4 million, 25% was variable. And the fixed expenses, excluding advertising and depreciation, so we have now the fixed expenses for a total of 3 million. Then we deduct 1.5 million of advertising expense and 600,000 for depreciation. So this is now for a difference of 900,000. Advertising allocated to the first quarter, since 1.5 million is good for the year. So 1.5 million is to be divided by 4 quarters. So for this quarter ending March 31, 375,000. And then depreciation from March 1 to March 31, of the total of 600,000. That's good for the year. And the equipment was available for use only on March 1, 2020. So we now have the 600,000 multiplied by 1 over 10. 1 over 10, that's only for the month of March. So we have 60,000. So for the total expenses in the first quarter of 2,335,000. Now you have the explanation of how this depreciation of 60,000 was arrived at. So in other words, that's your total of 2,335,000. And by the way, the fixed expenses of 3 million, that's the difference between the total of 4 million and 1 million is variable. So we have 4 million minus 1 million, which is variable. That's why we have the fixed expenses of 3 million. Then we now go to problem 10-12, and 10-12 has several requirements. So we have now questions number 1 up to number 4. Okay, so for question number 1 of 10-12, what amount of income should be reported in the first quarter. So, at the beginning of current year, Cambridge Company entered into a 20 million long-term fixed price contract to construct a factory building. The entity accounted for this contract under the percentage of completion at the end of each quarter. Now we have the quarters 1 to 4, and we have the percentages of completion for quarter end of quarters 1 up to 4. So, and you are given the estimated cost. No work was performed in the second and fourth quarters. So, in other words, we are given the information that no work was performed in the second and fourth quarters. That's the main reason why in the second quarter the percentage of completion is retained at 10%, and at the end of the fourth quarter it's still 25%, just like that of the third quarter. So the income that should be reported in the first quarter is equal to, if you have the gross income equal to 5 million, we have 5 million as difference between 20 million, that's the contract price, and the estimated cost of 15 million. So we have the estimated profit of 5 million. Then that's the gross income. You multiply it by the percentage of completion at the end of the first quarter, which is 10%. So the income earned is 500,000. That's for number one. What amount of income should be reported in the second quarter? There is no work performed in the second quarter. So you still have your estimated cost equal to 15 million, and the work done is still at 10%. So the estimated cost is still the same, and the income to be reported is zero. Now, what amount of income or loss should be reported in the third quarter? Now we have the gross income, that's equal to 800,000. That's difference between 20 million and 19,200. So 800,000 multiplied by the percentage of completion of 25%. So we have the cumulative income equal to 200,000. That's up to the end of the third quarter. Now, since we have already reported an income earned for the first quarter, we have computed the income earned in the above computations of 500,000. So we have the loss in the third quarter equal to 300,000. It's a loss because in the first quarter you have reported 500,000, but the cumulative income up to the third quarter is only 200,000. So already you have a negative result. For question number 3, the amount to be reported is a loss equal to 300,000. And again, in the fourth quarter, there is no income to be reported because there is no work uh, done. And that the estimated cost is still equal to that of the third quarter. Now let's go to problem 10-13. 10-13 is a long problem. So you will notice that you have a long solution. We are required an income statement for the first quarter and a statement of financial position on March 31, 2025. 2020, being the end of the first quarter. Now we are given the condensed trial balance on March 31, 2020. So now you are given the balances of the debits and the credits, including cash, accounts receivable, inventory, prepaid insurance, notes receivable, land, and we have buildings and equipment for 18 million. While on the credit side, we have accounts payable, share capital, share premium, and we have retained earnings with a balance of 9.5 million. Okay. Then the amount of sales for here 25 million, and we have purchased 17 million, distribution cost 3.2 million, and administrative expense of 2.4 million. Uncollectible accounts typically averages 1% of net sales, and we have our gross sales and as well as the net sales equal to 25 million. And on January 1, 2020, buildings and equipment have an average remaining life of 10 years. So that's now your buildings and equipment. We have one account with an amount of 18 million. Now they have a buildings and equipment have an average remaining life of 10 years. Uh, and one third of the account balance consists of assets related to selling activities. The activity use the entity uses the straight line method. Okay, so that's now for the remaining life of the building and equipment. That's 10 years, and one third of the account balance consists of assets related to selling activities. The notes receivable is dated January 1, 2020. That's the notes receivable, and you've already seen the notes receivable account uh, in the trial balance. The amount of the notes receivable is equal to 5 million. Notes receivable, so we have 5 million. Notes receivable dated January 1, 2020, matures in January 1, 2022, and carries a 12% interest rate. Interest will be collected annually starting January 1, 2021. Now, actually, we have the notes receivable, but there is no corresponding interest except if you are given this in the additional data. January 1, 2020, the entity had purchased a one-year insurance policy debiting the payment to prepaid insurance. So we now debit to prepaid insurance and credit to cash. In the books, in the trial balance, prepaid insurance got a balance of 40 here. A prepaid insurance, the given amount is 400,000. We have the gross profit method issues to determine the interim inventory. Gross profit has averaged 40% of sales. So if we base our gross profit this time, it's on net sales. The income tax rate is 30%, and the remaining income tax will be paid on or before April 15. Now, as required, prepare an income statement for the whole quarter. So we now begin with the heading. That's for the 3 month ended March 31, 2020, meaning it's good for one quarter. Now, given the amount of sales of 25 million, then we deduct cost of sales, which is equal to 60%. Now, it's given number 5 that the gross profit method is used to determine the interim inventory. The gross profit has averaged 40% of net sales. So if it's 40%, meaning the gross profit rate is determined, or here it's already given. So we have now the sales, and we have to multiply the 40%. That's for the gross profit, while the cost of goods sold is 60%. So we now have 60% of sales is 15 million. So we have the gross income of 10 million. Then we add the interest income. It's 5 million multiplied by how many percent? 12 percent. And finally have a balancing figure of here. It's gross income of 10 million, and then we add interest income 5 million. You multiply by 12%, and we multiply it by 3 over 12. That's good for one quarter. Now, the interest income good for one quarter is 150,000, and we add it to gross income. The total of 10,150. That's the total income. But take note that we have already two considerations here. The gross income of 10 million, interest income of 150,000. So we have now the total income of 2,150,000. Then we deduct selling expenses of 3,350,000. Admin is 3,050,000. So selling expenses is equal to 3,350,000. Now, as stated, here we have the prepaid insurance, no? But that will be subject to adjustment. Now, for the gross income of 10 million, and then we add interest income, that's good for 5 million. Interest income is based on the 5 million balance of the notes receivable, and you multiply by 12% times 3 over 12. Considering that you have your notes receivable dated January 1, matures on January 1, 2022, with a 12% interest rate. So to determine the interest income, we have 5 million multiplied by 12%, and we multiply by 3 over 12. So meaning that's 3 over 12 from January 1 up to March 31. So the interest income of 150, total income 10,150. We deduct the selling and administrative expenses. So for selling and administrative expenses, we now have 3,350,000 and 3,050,000. Here we have the distribution cost initially for 3,200,000 and administrative expense or cost of 2,400,000, but subject to adjustments. That's why you have 3,350,000 and 3,050,000. That's your income before tax. Then we deduct the tax equal to the rate of 25%. The income tax rate is 30%, and the income tax will be paid on or before April 15, 2020. But here we have the amount here, the income tax 30% based on the taxable income. So we have net income of 2,625,000. Now the distribution cost, that's given at 3.2 million, and then we are adding a depreciation. The amount of depreciation is 450,000, and then you multiply it by one third. Now, considering that the building and equipment have an average remaining life of 10 years, so the cost of the building and equipment is 18 million. If we divide it by 10 years, so that's 1.8 million per year. One third of the account balance consists of assets related to selling activities. So if one third of 18 million relates to selling activities, in other words, one third of 18 million is 6 million, and you divide that by a period of 10 years. 6 million divided by 10 years is 600,000 supposed to be. That's on your buildings and equipment. However, this time the company, as it uses the straight line method. So again, we have the assets related to selling activities. Now, we have the depreciation divided, or we multiply by one third. That's your selling activities. So one third of the account balance consists of assets related to selling activities. Only one third of 18 million relates to selling activities. However, it does not mention about any uh, salvage value on the building, but it only stated that one third of the building and equipment which was acquired on January 1 or on January 1, 2020. The building and equipment has a life of 18, or cost of 18 million. If you divide that by 10 years, that's only good for 1.8 million a year. And 1.8 million a year, you have only one third relating to selling activities. So we have now the 450,000 for a depreciation. Still, we divide it by one third. The depreciation here is only good for 3 months. So if you have six, that's 18 million, and we multiply it by one third, so we get 6 million. Divide by 10 years, 6 million divided by 10 years equal to 600,000. But we only involve a period of 3 months. Or you can just multiply 18 million divided by 10, so that will give 1.8 million. That's your annual depreciation. And 1.8 million good for 1 year, and you divide it by 12 months, so you get 450,000 a month, 450,000 a quarter, no? So I'll repeat, 18 million, you multiply it by, or you divide it by 10 years, you get 1.8 million. That's good for 10 years. And 1.8 million divided by 12. And now we have only 450,000 for 3 months till we multiply it by one third. For the distribution cost, 150,000 added, so the total depreciation added to 3.2 million, a total distribution cost of 3,350,000. Now for the administrative, we have 2.4 million, and then the depreciation of 450,000 multiplied by two-thirds, that will give 300,000. That's the remainder of 450,000 above. So minus 150,000, the remainder is for administrative expense of 300,000. Then we have the insurance. The amount of insurance purchased for 1 year, that's debited to prepaid insurance of 400,000, and we divide it by 4 quarters. So 1 quarter is 100,000, and we record it as part of the administrative expense. And finally, the doubtful accounts, sales amounting to 25 million, and as stated, uncollectible accounts equal to 1% of uncollectible accounts is 1% of net sales. So we get the amount of 250,000. So 250,000, that's your doubtful accounts, or sometimes we call it bad debts, no? We call it bad debts. Okay, so again, I'd like to explain on depreciation. The cost of the building and equipment is 18 million. Of 18 million, we divide it by 10 years, so we get 1.8 million for 1 year. 1.8 million for 1 year divided by 4. 4, because we have 4 quarters in 1 year. That's why you have 450,000. That's good for the quarter only, so 3 months. Then we multiply it by one third, allocated to distribution, and two-thirds to administrative. Now, the statement of financial position will be prepared for March 31, 2020. So, with this corresponding adjustments in order to support the balances given for the statement of financial position by March 31, 2020. So we have current assets given in the problem, current assets of 1 million. Then we have accounts receivable, trade, and other receivables. So we have now your accounts receivable in the amount of 2 million. We have our uh, trade and other receivables 1.9 million. As here we have accounts receivable of 2 million, allowance for doubtful accounts, we deduct 250,000 as computed in the income statement. So we have 250,000 doubtful accounts. So we deduct this from accounts receivable, and we have accrued interest on notes receivable equal to 150,000. We have the notes receivable, the amount of 5 million stated January 1, 2020, and matures in January 1, 2022, and the interest rate is 12% a year. So meaning good for 1 year is 12%. For the quarter, it's only 3%, and we multiply it by the face or the principal amount of 5 million. That's why we have 150,000. So again, accrued interest on notes receivable is equal to 3% of 5 million. Why 3%? Because the annual interest rate is 12%. So I multiply it by 3 over 12, good for the quarter. That's why we have the total trade and other receivables in the amount of 1.9 million. Then the inventory is on January 1 given is 1.5 million in the trial balance, 1.5 million, and then we add purchases in the problem is 17 million. Then we have the total goods available for sale of 18.5 million. We deduct cost of sales equal to 15,000. That's your cost of sales. So we have now the inventory end equal to 3.5 million. Since the gross profit rate is 40%, meaning the cost rate is 60%. 60% of sales, which is 25 million, cost of sales is equal to 15 million. So again, compute cost of sales equal to 60% of 25 million or 15 million. So we have the inventory on December 31 equal to 3.5 million. That's the inventory. Then the prepaid insurance of initially it was for a prepaid insurance of 400,000. This good for 1 year or 4 quarters, and 100,000 is already expired in the income statement. Your insurance expense is 100,000, so the prepaid insurance balance of 300,000. For the non-current assets, we have the notes receivable equal to 5 million. That's the notes receivable, and we have now the property, plant, and equipment for 19,050,000, land 1,500,000, building and equipment of 18 million, and we deduct the accumulated depreciation of 450,000. So the net carrying amount or the book value of your property, plant, and equipment is 19,050,000. Now, if the total assets equals 30,750, we continue with current liabilities equal to accounts payable 8,500 given. Then we have income tax payable computed in the income statement. Normally, debit to income tax expense and credit to income tax payable. So we have the total of the current liabilities. Then for shareholders equity, we have share capital. Here the beginning balance is 5 million, and then we add share premium equal to 4 million and the retained earnings of 12,125,000. Initially, the balance of retained earnings is 9.5 million. Then we are adding net income from the income statement. Our net income is 2,625,000. That's our net income, which we have to carry to our income. Okay, income statement. So we have the net carrying amount. We carry that to the statement of financial position. So retained earnings add net income for the period. So the balance, the retained earnings end is equal to, okay, there we have 12,125,000. The total of liabilities and equity equals the total assets. So we have this problem, which is a straight problem. Another straight problem here is 10 does 14. 10 does 14, then we have 10 does 15. In 10 does 14, prepare an income statement for the first 6 months of 2020. So that's good only for semi-annual figures. Then an interim income statement for the second quarter. The company prepares quarterly and year-to-date interim reports. The entity provided the following interim income statement for the quarter ended March 31. So we have sales less cost of sales equals gross income. Then we add dividend revenue. We have the total income. Then deduct distribution cost, general expenses, depreciation, interest expense, and finally income tax. So we have the net income of 1 million. On June 30, 2020, the accountant completed a worksheet in preparing the year-to-date income statement. The worksheet showed the following income statement accounts. We begin with sales, 20 million. That's, by the way, the first income statement given was for the interim period ended March 31 or the first quarter. Then second income statement ending June 30. The worksheet now showed the following income statement accounts. So we have sales, then interest revenue, dividend revenue, cost of sales, then we have distribution cost and cost of sales in general expenses. Okay, so we have two requirements in Problem 10-14. The first is an income statement for the first 6 months based on the given data at the bottom. Okay, so this is for the first 6 months. We deduct from sales the amount of cost of sales of 11.5 million. We have the gross income, and then we add the interest revenue and the dividend revenue, 250 and 500,000, leading to the total income. Then we have to add or deduct the other figures. We have now your interest revenue, and we have your dividend revenue. So interest revenue of 250,000 and dividend revenue of 500,000. Total income of 9,250,000. Then we deduct this distribution cost given of 2.5 million. That's your distribution cost, and the general expenses of 1.1 million, and 700,000 depreciation together with interest expense. Okay, so we have now your for the 6 months ended June 30. We have now the net income of 3,350,000. Okay, that's second requirements, interim income statement for the second quarter of 2020. So that's for the 3 month ended June 30. While the one above is good for 6 months, the second requirements only an interim income statement only for the second quarter of 2020. If we follow the calendar year, the second quarter ends June 30, and it begins April 1. So we have now sales of 12.5 million. The difference, take note that the figures given above are good for 6 months beginning January 1 up to June 30. The figures given above are only good for interim income statement for the quarter ended March 31. Okay, so we have now the interim income statement that's good for second quarter of 2020. We have sales of 12 million, then deduct cost of sales equal to 7 million. That's your cost of sales for the period beginning April 1 up to June 30. If your cost of sales is 11.5 million, that's good for the whole 6 months up to June 30, 11.5 million, which amount we are going to deduct 4,500,000. So 11.5 million minus 4.5 million, because these figures above are good for the quarter ending March 31. Subalit diri ang January, February, and March. The figures below are given for the period actually from January, no, to March. You are given the one above, and then down you have from January to June. So we are going to prepare an income statement for second quarter, that's beginning April. So April, May, and June. Now, for the 3 month ended June 30, so bali, beginning lang niya April. Sales, good for 6 months, 12.5 million. We deduct 7.5. Okay, so we have now 20 million, I mean, good for 6 months from January to June. Then we deduct 7.5. That's from January to March. So, bali, ang inapangita nato nangalin April up to April 30. Okay, so we have now the difference sales 20 million minus 7.5. So we have now sales of 12 million. Then cost of sales in the amount of 11.5 million minus 4.5. Okay, minus 4.5. So that gives us the difference of 7.5 million. That's your cost of sales for the 3 months. So the period begins on May 1 up to uh, June 30. April 1 up to June 30. Sales. So this time cost of sales, we have the gross income and the interest revenue as we have computed above is 250,000 and the dividend revenue of 200,000. So we have now the amount of total income as presented. So anyway, we are going to revise sales 12.5 million, then deduct cost of sales equal to 7 million. So we have the gross profit. The gross profit of the difference, no, dapat we have to start on May here March 31 muna ang iyang beginning sa previous nga period or April 1, and now we have to end up to June 30. So the interest revenue and dividend revenue are all given. So dividend revenue and the interest revenue. For the interest revenue of 250,000 and the dividend revenue equal to 200,000. Now we have the dividend revenue normally is actually to be added, no, to other income. So now we have the amount of sales. That's good for the 3 months beginning April 1 up to June 30. Sales, cost of the sales, then we have the gross income, the interest revenue given at 250,000, and the dividend revenue, the amount given is 500,000 and 300,000 for the 3 quarters. So meaning we have the difference of 200,000, leaving the total income of 5,950,000. 5,950,000 for your total income. Then you have to deduct the distribution cost, 2.5 million minus 900,000. So we have the difference of 1.6 million. Again, for the general expenses, we only have 600,000 for 1.1 million minus 500,000 is 600,000. Then we have depreciation for 700,000 minus 400,000. And we have the income tax expense of 900,000. So we get the difference is net income for 2,350,000. We are adding one item. You have your income tax expense. So finally, the net income for the period is 2,100,000 or 350,000. Okay, now we go to 10-15. The company encountered the following product cost situations as part of the quarterly financial reporting. The entity conducted inventory count at the end of the second quarter and end of the fiscal year. Total gross profit rate, actual gross profit at the end of the second quarter, and the actual gross profit rate at the end of the second quarter. Now, typical gross profit rate, actual gross profit rate at the end of the second quarter, and actual gross profit rate at the end of the first quarter. So now we have first, second, third, and fourth. There was a temporary decline in inventory value. So the inventory a decline of 100,000, I suppose, in the first quarter, which was recovered fully in the second quarter. So we have now the requirements. Compute for the cost of goods sold for each quarter and the gross income for each quarter. Given are the income tax rates, the actual gross profit rate at the end of the second quarter. Then we are given the quarterly sales from 25 up to 30 1. So we have now 10 does 15 for 10 does 15. Okay. So we have now to compute for the cost of goods sold for each quarter, and the second is compute for the gross income for each quarter. So we have now the typical gross profit rate, the actual gross profit rate at the end of the second quarter, and at the now we are asked to determine the cost of goods sold for each quarter. So for the first quarter, we have 70% because the typical gross profit rate is 30%. Then the amount of the sales for the quarter is 10 million. So cost of goods sold 7 million. Then we have the loss on inventory write down equal to 100,000 cost of goods sold after the inventory write down. There was a temporary decline in inventory value of 100,000 in the first quarter, which was recovered fully in the second quarter. So we are adding the loss on inventory write down to cost of sales. Then for the first and the second quarters, the total sales for the first and second quarters is 18 million, and the gross profit rate at the end of the second quarter is 35%. Therefore, the cost of sales is 65%. If we multiply the cost of sales rate of 65% and we multiply it by 18 million, we get 11,700,000. That's the amount of cost of goods sold for the first and second quarters. So we are given total of 18 million. Next, we have the cost of goods sold before reversal of uh, profit. No, profit rate is deducted from 100%, so you get the cost rate. Now, the cost of goods sold for the first quarter before the inventory write-down was 7 million. We have the cost of goods sold before reversal of write-down at the end of the second quarter, 4,700,000. Cost of goods sold before reversal of write down, second quarter. Then for the third quarter, cost of goods sold and inventory write down. So for the first and second quarters, the cost rate is 65% of the total sales for the two quarters. So we have the cost of goods sold equal to uh, 11,700,000. Then we deduct the cost of goods sold reported during the first quarter of 7 million before the write down. So we have the cost of goods sold before reversal of write down during the second quarter. It's 4,700,000. And the gain on reversal of write down equals 100,000. So we have now the difference of cost of goods sold after inventory decline. So we now have the cost of goods sold. Then we now go to uh, cost of goods sold before reversal of write down. We have second quarter, so we have 4.7 million gain on reversal of write down. We have to deduct back 100,000. So the cost of goods sold is okay. So next, third quarter, 70%. That's the gross profit rate. I mean the cost rate. 70 percent times 7 million. That's the amount of sales for the third quarter. And then we have the loss on inventory write down equal to 150,000. There was a net realizable value adjustment of 150,000 in the third quarter. So we are now adding loss on inventory write down 150,000. The cost of goods sold after the inventory write down is 5 million. Okay, so we have now the third quarter cost of 70% times the amount of sales of 7 million. So we get 4.9 million, and the loss on inventory write down, we are the loss on inventory write down is 150,000. thousand. We add it to the loss on inventory valuation. Actually, we have the amount of 150,000. Add it to 1 million. The total, or add it to the third quarter's cost of 4.9 million. We add 150,000 being the loss, the write down. So we have the amount of 5,050,000, the cost of goods sold after the inventory write down. Now for the third requirement, or I mean for the cost of goods sold and the gross income for each quarter. So the cost of goods sold for the entire year is 75% multiplied by 40 million. That's given amount of sales, given man ang write down. So we have now the cost of goods sold, and we deduct the amount pertaining to first sem, second sem, and quarter. 7 million times 70%, 4.9 million, and then we are going to add the loss on inventory write down for the quarterly. We have the loss. We have the amount of 4.9 million. 4.9 million. That's for the third quarter. The loss on inventory write down equals how much? That's for the third quarter. It's 4.9 million, and we add back the loss on inventory write down of 5,050,000. Now the cost of goods sold for the entire 50%. Okay, so the cost of goods sold for the entire quarter, 75% multiplied by 40,000 is equal to 30,000. Then deduct cost of goods sold before write down and reversal. For the first quarter, it's 7 million. Second quarter, 4.7 million, and you have the amount of the cost of goods sold before reversal of write down. For the fourth quarter, we have the gain on third quarter. First quarter, 7 million. Second quarter, 4.7 million as computed above. Third quarter, 4.9 million. Again, it's computed. So we have 13.4 million before reversal of write down. When we have the gain on reversal of write down of 150,000, we have the cost of goods sold after reversal of write down equal to 13,250,000, whereas based on the computations for the gross profit rates, we have the amount of 30,000. Now we have the breakdown here. Cost of goods sold for the entire year is 30,000. Now we have 10-16. You can take note of the of the 10-16. Take note of the letter answers for 10-16. The letter answers for 16, 17, and 18. There, the letter answers. Okay, then we move on to chapter 11, chapter 11, we have chapter 11 now. We have the operating segment. So we move on to chapter 11. Tura, chapter 11 na. Okay, now we go to chapter 11. Chapter 11 is operating segment, and we have the following objectives in the study of operating segment: to identify the core principle of segment reporting, to understand the concept of an operating segment, to identify the criteria for the recognition of a reportable segment, and to identify the information required to be disclosed for a reportable segment. Now, I will be discussing 11-1 up to 11-15 because I assigned 11-16. Okay, so 11-1, what total revenue should be disclosed by the reportable segments? So the reportable TIMI company provided the following information in relation to revenue earned by operating segments for the current year. So we have now these segments: ALO, BIX, C, and DEAL. Now, for the reportable segments, only BIX and DEAL have a revenue of 10% or more of the combined revenue. The revenue includes both sales to unaffiliated customers and inter-segment sales. Now, if we have the total revenue sales to unaffiliated customers equal to 60 million, and we have the inter-segment sales equal to 23,000. So the total revenue is 83,000. Now, for ALO, if we divide the total revenue of 8 million over 83, it's not uh, 10% because the requirement is revenue of this segment should be 10% or more of the combined revenue. So that of ALO is only 8 divided by 83. It's less than 10%. BX 12 million over 83 is 14%. Then C, it's 4 million only. And deal 59 million over 83, which is 71%. So the total revenue of BIX and deal is 71%. Now they are reportable segments because the revenue earned by these two is 10% or more of the combined revenue. Next, we go to 11-2. 11-2 now requires for how many reportable segments does Corey have? So how many reportable segments in 11-2, no? So we have now to determine the number of reportable segments. So we have now the total revenue percentages from A up to F. The total revenue of A as compared to the total. Now, the total revenue in millions. So, for 300, no, The total revenue of A is 10 million. Then we have D of 8 million, C of 6 million, 3 million for D, 4,250,000 for E, and 1,500,000 for C. So we have now the total revenue, and we divide that of the revenue of A over the total. Okay, so the revenue of A over the total, if the percent of revenue earned by this segment is 10% or more, so meaning it's considered to be a reportable segment. So in the case of A, if we have the total of 32,750,000, if we divide that of A, so we divide 10 million by 32 million 750,000, then we get 30%. It's 30.53%. For B, it's 24.43. For C, 18.32. For D, it's only 9.16. E, 12.98. And F is only 4.58. Now, with regards to profits, we also add the total profit, and A divided by the total profit, and the same with the assets. So, the question, how many reportable segments does Cory have? A, B, C, D, and E are reportable segments because the revenue or operating profit or asset is at least 10% of the combined amount. So if you look at A is qualified in all areas. So whether it's total revenue as the base, profit, or assets, A is qualified to be a reportable segment. Okay? While B still qualifies, whatever is the base. C also. D, based on revenue, it cannot qualify, nor based on profit. However, based on assets, it's 11.11. Then we have E, is qualified in all bases, and F is not. So meaning only F is not considered a reportable segment. Take note that in 11-2, we have it's either based on total revenue or operating profit or asset. That's the possible basis. Now we go to 13-3. Question, what are the reportable segments based on profit or loss? So we have now the total profit figure is the basis for identifying the reportable segments because it's higher than the total loss figure. Now you compare the total profit with the total loss. Accordingly, those segments with profit or loss of at least 10% of 4.8 million or 480,000 are reportable. Thus, B, W, and X are reportable. So we have B W and X are reportable. Actually, we need 480,000, which is 10% of 4.8 million. So we have now B. Its profit is 3.4. Ang need malang is 480,000. Likewise, we have W. Okay, we have W, and because of the 10% rule, and X here for 2 million. X for 2 million, even if it's a loss, as long as it exceeds 10% of the profit or loss. So here Y and Z cannot qualify because they have not reached 480,000. Next, number 4, we have the requirement: which piece of information determines that the North American division is a reportable segment. Now, the profit is 1.2 million, 1.2 million divided by 10. Okay, 1.2 million divided by 10 million. That's the profit. And we have this segment information. We have the profit of 1.2 million. So Macbeth Company, an entity based on a recognized stock exchange, reports operating results from a North American division to the chief operating decision maker. So we have now the amounts of revenues and profits, segment information for the current year, revenue, profit, assets, and we have the number of employees. The entity's results for all these segments in total are. So we have now revenue, profit, assets, and number of employees. This now for the entity. So we have for profit, it's 1.2 million, the profit for the current year, divided by the results amounting to 10 million. Actually, it's 12 million. So which piece of information determines that the North American division is a reportable segment is letter B. So meaning it's profit. Next, number 5. In number 5, the question is, under the revenue test, what is the minimum revenue of a reportable segment? So we have now the sales to unaffiliated companies, sales to unaffiliated companies equal to 20 million. Then we have the inter-segment sales equal to 5 million. Now we have sales of 25 million. Now the revenue criterion is at least to 2.5 million. Next, 11-6 with two questions. Question number 1. What combined total assets of all operating segments at year-end amounted to 45 million? The combined total assets of all operating segments at year-end amounted to for 45 million. Company subject to the requirements of segment reporting. In the income statement for the current year, the entity reported revenue of 50 million, excluding inter-segment sales of 10 million, expenses of 47 million, and net income of 3 million. Expenses included payroll costs of 15 million with a combined total assets of 45 million. What is the minimum amount of sales to a major customer in 11-6? The minimum amount of sales is 10% of 50 million. That's your minimum amount of sales to a major customer. So you exclude the inter-segment sales. So we now multiply 10% times 50 million. In question number 2, what is the minimum amount of external revenue to be disclosed by reportable segments? So the minimum amount of external revenue to be disclosed by reportable segments. So we have now 11-6, question number 2. Question number 2, we have 75% of 50 million. That's the minimum amount of external revenue to be disclosed by reportable segment. Minimum amount of external revenue to be disclosed by reportable segments. Now we have the 75% rule. Now in 11-7, what is segment C's operating profit? The company discloses supplemental operating segment information. The following is available for the current year. So for X, Y, and Z, and for segment sales and traceable expenses. Then we have the additional expenses, including indirect segment expenses, general corporate expenses, interest expense, and income tax expense. The interest expense and income tax expense are regularly reviewed by the chief operating decision maker as a measure of profit or loss. Appropriate common expenses are allocated to segments based on the ratio of segment sales to total sales. What is segment sales? Operating profit. Now, sales segment C is 3 million. Then we deduct the expenses. Traceable is 1.5 million. Then we have the indirect expenses equal to 3 over 12 times 1.8 million. Now we are adding sales of the three segments. So we now get 12 million. That of segment C. For the indirect expenses, we now divide 3 over 12. So 3 is the sales of segment C. 3 over 12 times 1,800,000 for the indirect segment expenses. So we get 450,000. For the interest expense, we have 3 over 12 multiplied by 600,000. And finally, for the income tax, okay, we have the amount of total expenses of segment C is 2,200,000. The segment profit is 800,000. General corporate expenses are not allocated to operating segments as a measure of profit and loss. So the answer to 11-7 is C. C or 800,000. Now we go to number 8. What amount should be reported as operating profit for segment 1? Ray Company has 3 lines of business, each of which was determined to be reportable segments. So we have sales number 1. We have to now identify sales aggregated 7.5 million in the current year, of which segment 1 contributed 40%. Traceable costs were 1,750,000 in the current year, of which segment 1 contributed 40%. Traceable costs were 1,750,000 for segment 1 out of a total of 5 million for the entity as a whole. The entity allocates common cost of 1.5 million based on the ratio of its segments income statement, and we have now the entity allocates common cost. This is the traceable, or we have the entity allocating common cost of 1.5 million. So in 11-8, we have sales of segment 1. Segment 1 is being asked for sales of 3 million. That's for segment 1. Sales 7.5 million, segment 1 contributed 40%. So in other words, sales of segment 1 is 3 million. Then we have the traceable cost given at 1,750,000. So the profit before common cost is 300, no, traceable cost. The difference is profit before common cost of 1,250,000. Okay, so we have now the common cost 1,250,000. That's the profit before common cost. Then the common cost 1,250,000. That's the profit before common cost of segment 1. We divide it by 2.5 million multiplied by 1.5 million. So we have 2.5 million and the amount of 1 in number 8, the amount of profit of 500,000. Now we are given the total revenue column 7.5 million and the traceable cost of traceable cost of 5 million. That's why we have the profit before common cost of 2.5 million. So take note that we have possibly traceable cost of 1,750 only for segment 1 out of total of 5 million. So we now begin with segment 1, sales allocated of 3 million. We deduct the traceable cost, and we have the profit before adjustment. Then deduct the common cost. Common cost is 1,250,000 divided by 2,500,000 for the total column and multiply it by 1.5 million. So finally, after leaving, okay, so we have now segment profit of 1 million. Take note that segment 1 has a profit equal to 500,000. Now the amount of allocated common cost is based on the ratio of segment's income before common cost to the total income. That's why we are using 1,250,000 and 2,500,000. Next, we have 11-9. What amount should be reported as segment A's profit for the current year? The company has three reportable segments. Common costs are appropriately allocated on the basis of sales. In the current year, segment A had sales of 3 million, which was 25% of Hyde's total sales, and had a traceable cost of 1.9 million. In the current year, the entity incurred, okay, in the current year, segment A had sales of 3 million, which was 25% of Hyde's total sales and traceable cost of 1.9 million. In the current year, the entity incurred segment costs of 500,000 that were not directly traceable to any of the divisions. Segment A incurred interest expense of 300,000 in the current year. Interest expense included in the issuance of uh, the division. Segment A incurred interest expense of 300,000 in the current year. Interest expense is included in the measure of profit or loss. Now, what amount should be reported? Segment A profit and segment revenue. What amount should be reported? Segment A's profit for the current year. So we now begin with sales of segment A, given is 3 million, then deduct expenses. Traceable operating is given in the first paragraph, 1.9 million, then the allocated indirect cost equal to 125,000. That's the allocated indirect cost, and the interest expense is given at 300,000. So the total, and we deduct it from the net profit or from the sales. So if we deduct it from the allowable items to be deducted, we have segment profit equal to 675,000. So let's repeat the determination of the answer. Segment 1, sales of 3 million. The traceable cost is 1,750,000. Then we have profit before common cost 1,250,000. That of the other column is 1,250,000. So we have now 1 million segment profit. Total revenue as the basis is 1 million, while that of segment 1, the basis is 500, or is 1 million total revenue. Segment 1, segment profit is 500,000. That's now in 11 dash 8. In 11 dash 9, we have the amount of 675,000. In 11 dash 10, the answer is sales of segment 1 is 25% of 14 million. Now we are answering 11D. There are 5 segments, and the contribution to total sales and the cost. Eagle Company operates in several different industries. Total sales for the entity totaled 14 million a year. In total, common sales amounted to 6.5 million for the current year. For internal reporting purposes, the entity allocates common costs based on the ratio of a segment's sales to total sales. So we have now the segment number, contribution to total sales, then cost specific to the segment. So what's the operating profit of segment number 1? So we now begin with sales. 25% of 14 million. That's the contribution to total sales by segment 1. So 25% of 14 million is 3.5 million. Then we deduct specific cost for segment 1, given is 1.1 million. Then we have the allocated common cost, 25% of 6.5 million. That includes the amount reported, no, by segment 1. So the amount of operating profit of segment 1 is 775,000. Now we go to number 11. In number 11, what amount should be disclosed at Delta's profit for the current year? So sales of the Delta division is given at 8 million, and we deduct traceable cost equal to 4,800,000. Then we have to deduct allocated indirect cost. What's your allocated interest cost? Indirect cost is 65. Okay, so we have 60. The allocated indirect cost. Segment profit is equal to 2,240,000. Next, in number 12, what does the problem require? Number 12, for purposes of the segment reporting, what amount should be reported as segment profit? So the amount to be reported It does not define anymore segment revenue and segment expense. As a consequence, an entity shall have a very wide discretion in measuring segment profit or loss. So, in 11-12, the answer is letter D, 1.5 million. That's now for uh, looking for. Okay, so 11 does 12 is letter D. 11 does 13, 14, and 15 are straight problems. So in number 13, we have this as straight problems 13, 14, and we have number 15, that's the end, no? 16 we will reserve. All right, so we now go to 13 does 13. What does the problem ask for? Prepare the necessary disclosures for diversity company in relation to operating segments. Now we have segment A and B, and we have others. Then we have the figures for sales, segment expenses, and segment assets. And we have the total assets of 65 million include general corporate assets of 5 million. Total segment expenses of 33 million include general corporate expenses of 24 million. Okay. The total assets of 65 million include general corporate assets of 5 million. Total segment expenses of 33 million include general corporate expenses of 7, or we have corporate expenses of 2 million. The chief operating decision maker does not allocate income tax as a measure of profit or loss. So we have now to prepare the necessary adjusting entries in number 13. First entry there. Let's try to analyze. Prepare the necessary disclosures for diversity company in relation to operating segments. So for requirement number 1, okay, requirement number 1 for 11-13. Oh, sige. 11-13. Oh, now, 11-13, we are given the sales, segment expenses, and segment assets of segments A and B and others. Now, the company total assets of 90,000 at year end, and provided the following condensed income statement for the current year. Now we have sales, expenses, okay, expenses. Then we have income before income tax expense, and net income. The entity has two reportable segments and thus developed the following related commissions. So now for column segment A, segment B in revenue, if you open your, okay, there are two reportable segments and the total assets of 65 million include general corporate assets of 5 million. The total segment expenses of 33 million include general corporate expenses of 2 million. The chief operating decision maker does not allocate income tax as a measure of profit or loss. So we have now the necessary disclosures of profit or loss in assets. So for segment A and segment B, segment A 25, segment B 15, and others 5. So this a total of 45 million. Then we have the profit or loss for 7.56 million and even. Okay, 7 given ang aton nga profit or loss uh, with the corresponding segments. So for segment A, then segment B, and we have the uh, others. Okay, so we have now the sales external adding segment A with segment B and the others of 5 million. So the total of 45 million. Then the profit or loss for segment A, the profit is 7 million. That's the difference between 25 and 18. So profit is 7 million. Segment B, 15 minus 9, 6 million. And others, 5 million minus 4 million. So it's 1 million. We are now adding sideward sales total 45,000. Profit or loss, okay, 14 million, no? Ang sales, 45 million. And total assets of 60 million. Now, for the reconciliations, revenue of reportable segments. The revenue of reportable segments is 40 million and the revenue of non-reportable segments of 5 million. So we are now given the total assets of 65 million include general corporate assets of 5 million. Total segment expenses of 33 million include general corporate expenses of 2 million. And we have above the company had total assets of 65 million at year end and provided the following condensed income statement for the current year. So we have now sales of 45 million, expenses of 33 million here, 33 million. And we have the income before income tax of 12 million, the income tax of 3.8 million, so net income of 8.2 million. So we now get the entity revenue shown in income statement is 45 million. Okay, so we have now the profit, the revenue of non-reportable segments amounted to 5 million. So in other words, only 40 million is the revenue of the reportable segments. So for profit or loss of reportable segments equals 13 million. The non-reportable segments is 1 million. So the total, we have to deduct the corporate expenses of 2 million and the unallocated income tax expense of 3.8 million. The entity net income shown in the income statement is 8.2 million. Now we have the total assets of the reportable segments given at 53,053. The non-reportable segments of 7 million and general corporate assets of 5 million, so the total of 65 million. So take note that we have others here would refer to non-reportable segments because, as stated, the entity has two reportable segments. So those are A and B. So meaning the others column refer to the reports of the non-reportable segments. So, non-reportable segments ang column others. Now we go to 11-14. Prepare a schedule that reports the segment profit or loss. Prepare the disclosures required for operating segments and prepare the reconciliations between segment information and the amount shown in the entity's financial statements. So we now have for 11-14 segments X and Y, and we have others. And we are given Congo company does business in several different industries. Condensed income statement for the entire entity for the current year is as follows. So we have sales of 60 million, then expense cost of goods sold 28 million, gross income 32 million. We have segment expenses equals 12 million, and depreciation of 3 million, income tax expense of 4 million. Now stated, the entity has two major reportable segments, X and Y. An analysis reveals that 1 million of the total depreciation expense and 2 million of the expenses are related to general corporate entities. So we have now the depreciation. We are going to deduct 1 million, and the expenses we are going to deduct 2 million. So in other words, for the depreciation, we only have the amount of 3 million. We have 3 million. we do not include the 1 million. Okay, and then for segment expenses, we only have 14 million minus 2 million. Okay, and profit or loss as provided in the problem. Disclosure of segment profit or loss. So for segment X, sales, external, and profit or loss and depreciation. So for X, sales external X, 40% of 60 million is 24 million. Y, 45% or 27 million, and others is 15% times 60 million. So that makes 9 million. Okay? So we have now the total, and then we deduct the cost of goods sold for a total of 28 million. Now we have the percentages to be used in the distribution of these expenses. Now take note, we have the gross income, and we have the operating expenses. We have the deduction of segment expenses, depreciation, and others. So for the requirement in the problem, prepare a schedule, report segment profit or loss. So we have now the segments profit or loss and the disclosures required for operating segments. We have now the disclosures required for the operating segments and the disclosure required. And number 3, the reconciliation. Okay, so we have now the reconciliations between segment information and amount shown in the entity's financial statements. Okay, so we have still the other problem. We have problem 15 is the so far a very long problem. So let's take this up. So by Thursday we will only involve your assignment. Determine the profit or loss for all the operating segments. So we have now the company is organized for management purposes into 3 major operating segments, namely furniture, stationery, and computer products. So we have now the three segments. There are other smaller operating segments. The cost of goods sold, okay, the cost of goods sold, distribution cost, administrative expenses, and finance costs can be allocated as 50% to furniture, 25% to stationery, 20% to computer products, and 5% to other segments. Now, the cost of sales related to inter-segment sales amounted to 240,000 to be allocated as 50% to furniture, 40% to stationery, and 10% to computer products. Okay, so let's start with requirement number one, the profit or loss for all of the operating segments. So we have now the computation of, first we have the external sales, then we have the inter-segment sales, and we have the total revenue. We deduct cost of sales, both external and internal. And then we have the cost of sales. Okay, gross profit. Oh, we have the distribution cost, administrative expense, and finance cost, segment profit or loss. That's the item computed in number one, profit or loss for all the operating segments. Then we have the minimum disclosures for the three segments. Minimum disclosures. Okay. So for external sales, inter-segment, profit or loss, finance cost, total assets. Okay. And also the total liabilities, and we have the corresponding reconciliation. Okay, so we have now the reconciliations, revenue, sales of reportable segments, 2,100,000, sale of non-reportable segments, and elimination of non okay, so we have the entity sale in the income statement. Okay. Alright, total assets, total liabilities, and the disclosures. Okay, so that ends our lecture for today. We will tackle the remaining problems. The ones that I assigned to you, we will so far needed. You only have 11, 16 down. Okay, so that ends chapter 11, excluding the remaining problems assigned to you. Convert, convert.